G'day everyone, welcome back to Pete's Investing. In this edition, we'll be talking about trading using the stochastic coupled with a triple moving average and applying a percentage gain and average down approach. Okay, what we have here is the price chart with a triple moving average applied, and the triple moving average is basically an exponential moving average 20 period, an exponential moving average 50, and a moving average 200. Up here we have the price chart, so the profitability chart. It shows you how much revenue we've generated, and we're trading $2,000 lots every time we buy shares. Down here we've got the stochastic with 14.3 parameters, and we use that for our entry criteria along with the moving averages. So the way it works is the exponential moving average 20, the pink line, must be above the exponential moving average 50, the blue line, which must be above the moving average 200. So that's our long-term trend. We want to make sure we're in that in for a long position. As well, once those criteria is met in the moving averages, we then focus on the stochastic 14.3, and that has to cross over the K line. The red line has to cross over the D line, the black line. So when it crosses over, and that also has to be less than 40, the value of 40. In other words, if it crosses over here, we don't enter. So it's got to be below 40 to enter. So once that criteria is all met, we enter our first lot of shares. So we write it along, and our exit criteria is when the close is greater than the average price. In this case, the close up here is greater than that initial entry or the average price, and the exponential moving average 20 drops below the moving average exponential moving average 50, which it does there. That's where we exit the trade. And here we're going to demonstrate the average down approach. So again, same criteria as the single entry. When the exponential moving average 20 is above the 50, and the moving average, and it's also above the moving average 200. As well, the stochastic 14.3 must do a crossover from the K line with the D line, and that must be less than the value of 40 on the stochastic indicator. We enter our first lot of shares. Again, we're entering $2,000 worth of shares there. In this case, the price goes against us. We don't panic. The price keeps going down until the price starts appreciating and the price action moves above the moving average 200. In that case, the EMA 20 is greater than the EMA 50 in this case. As well, the stochastic K line breaks above the stochastic D line when it's below the value of 40. So we enter our second lot of shares. Now we've got to be careful that when we enter that second lot of shares, it must be at least a 1% drop in share price from that initial entry. In other words, if that happened up around there somewhere above the initial entry, we wouldn't enter any more shares, because effectively you're doubling up the shares at the same price. We want to add more shares when the share price is dropped by a significant amount. In this case, we're using a 1% drop. In this example, the share price starts going sideways, drops a bit below the 200 again, a couple of times. We don't panic, then starts appreciating. And up here, we exit the trade when the exponential moving average 20 breaks below the exponential moving average 50. And that's also above our average price. Now, don't forget, the average price would have been somewhere in the middle here between that price and that price entry. So the average price would have been somewhere in the middle. And we exit the trade when those two exponential moving averages cross over on the downside. That's where we exit the trade. Here are the trading rules for the stochastic with the triple moving average. We enter when the exponential moving average 20 is in an uptrend, that is against, and then the exponential moving average 20 is greater than the exponential moving average 50, and the EMA 50 is greater than the moving average 200. And the K line of the stochastic is greater than the D line. Again, we're using the stochastic of 433, and the K stochastic line must be less than the value of 40. That's our initial entry. We exit the trade when the close is greater than the average price, and the exponential moving average 20 breaks down the exponential moving average 50. We average down, same as the entry of above, when the entry parameters are met, but also when the close is less than 1% drop on the price chart, and we buy two lots of the previous number of shares. So if we bought $2,000 in the first lot, we buy $4,000 in the second lot of shares. Okay, so let's see where our latest program fits in the overall ranking of the programs we've tested. So as you can see here, what I've got up here is just a parcel of shares which we back test on. And again, I'm not suggesting you trade any of these, just simply using these as a back test, because some of these shares go sideways, some go upwards, and some go in a more downward direction. So it gives us a nice balance of variation in share prices. The first table shows us the revenue generated. The drawdown table shows us the drawdown required. And again, the drawdown is simply from the highest point of profitability. So let's look at this chart, for example. So it looks at the highest point of profitability to the lowest point. That gap in terms of profitability is our drawdown, which we measure. And that goes out throughout the history back to 2007 that we've backtested all these. So the revenue, the drawdown, and then lastly, the profit over drawdown percentage, which is simply the revenue divided by the drawdown. So this is where you can see here the highlighted area is what we've tested today, this stochastic and triple moving average. It's generated 24,443 in revenue over the period, a drawdown of 19,776, and a profit over drawdown percentage of 126. The profit over drawdown is simply ranked, so the higher the percentage on average, and the average is that 126 is the average of those above. So we rank the averages of each of these testing strategies and rank them highest percentage to lowest. And today's strategy ranked at 18. So not our best result, but a couple of things to keep in mind. You'll notice it's not necessarily the highest profitability or the 18th ranked profitability. It actually ranked as 17th in terms of profitability. And just something to keep in mind as well is we use the profit over drawdown percentages as a ranking, not the revenue, because what we want to do is measure the revenue. So if you look at this example here, ranked third in terms of profit over drawdown percentage, but number 20, but 22nd in terms of revenue. And this one, but it's also ranked first in terms of drawdown. In other words, the least drawdown would have been required had we traded that particular strategy. So again, overall, not our best result in terms of strategies, but again, I'll keep these updated in future videos to show you the results as we move forward. Other thing to mention as well is a lot of these programs you'll be able to find in our playlists. So up here we've got the alligator strategy. We've got a couple of alligator strategies there, the CCI 350 strategy, another CCI 350 strategy. So our commodity channel index strategy is quite a very effective strategy we've tested. There's another stochastic strategy up here that was more better result in terms of what we did today. Another alligator strategy, smooth Hikinashi, etc. So I just gave you our playlist and review some of our historical backtesting on these results to get a better understanding. Here are some of my investing rules. Buy proven blue chip stocks only, avoid speculative stocks. This ensures the probability of the shares of the company you are buying has had a good track record and more likely potential of future growth. Buy stocks which pay dividends. Do a quick search of the stock before buying to ensure it recently paid a dividend or is about to. This is a good indicator that the company has future potential of growth. If the company recently stopped paying dividends, it may be a sign that their growth potential may be challenged. Don't short positions, go long only. If you short up an instrument which pays a dividend, you'll end up paying that dividend to someone else who went long on the same instrument. Do not trade on news. Price is already factored in the share price. If you read an article in the finance pages which talks about an event on the stock you're considering, the chances are it has already been factored in the share price. So you've missed that boat. I did a video in September 2021 titled Uranium Stock Too Late to Trade, which demonstrates the effect that news has or hasn't in the share price action. Suggest you watch that video to get a better understanding. To be able to ask specific questions, feel free to log on and sign up to the Pete's Investing Patreon page. That's where I get more specific questions answered and help support the channel. Thank you.